Hello and welcome to LAT's Weekly Market Insights here on the 4th of December 2020. Now this week we're going to change up. We're going to look at a technical indicator, and that indicator in particular is going to be the Fibonacci retracement and extension. We're going to discuss the theory of how to correctly apply it, and then we're going to have a look towards a live example on Kiwi Yen, which is in a wonderful technical downtrend at the moment, which gave us ample opportunity to utilize this tool. So what I can see on my screen at the moment are two uptrends drawn here in blue, and we know they are technical uptrends because they possess higher highs and higher lows. If I pop this in, this here is my first higher high. In order to confirm the higher low and therefore confirm the trend, we must see a break through that high. So as we come on and we post that new higher high, we are in a position to lock in that higher low down here. Again, we repeat that process throughout this uptrend. What this enables us to do is to remove some of the noise, the clutter from this chart, and some of the smaller non-significant swings, such as this one here. Here we can see we are taking the lowest point between those two highs to confirm the uptrend. Again, we continue on, we break through the high to post our new higher high, and now we see the new higher low, and again taking that lowest point between the two. Technical uptrend now in play. Now we're looking to use Fibonacci. We want to go in the direction of the trend. We want to look for continuation trades. In this instance, we are in a technical uptrend. We've established that. So I'm looking for a buy signal. And importantly, in an uptrend, when we're using Fibonacci retracement, we want to come from the previous higher low to the current high. So if I grab my retracement tool, take it from that previous higher low up to the current high, we can see we have this projected zone, and it is a zone. The 50 and the 61% typically most commonly accepted, 38.2% potentially also in play. And what we are looking for is after this impulsive buying pressure, we are waiting to see a move down into that 38 to 61% region where we can go looking for buy opportunities. Now, of course, this is secondary, so must be confirmed by the primary. However, once we fall into that 50, 61 in this instance here, we can go looking for opportunities to buy once confirmed by primary. So this retracement here giving us the confirmation and additional confirmation to take this market long. Naturally, therefore, it provides us with our entry level, okay, in and around that 50 to 61%. The Fibonacci extension, therefore, is to help us apply a target. So I've duplicated the trend here, and now we're going to say, where are we going to look to target? So that retracement, if I move that across to here, same rules apply. We're back to that 50%, 61% zone where we can look to put a buy signal in place. Let's move the retracement back to this side of the chart. And now let's introduce that extension tool. The extension coming from that previous higher low up to the current high. And as it says at the bottom there, back to the low of the retracement. So 3 reference points required, and what it provides us is this 100% extension level, also this 61% extension levels, and these become natural targets for our trades. So we're now looking for a potential buy signal off of that retracement zone, looking to take this market for a continuation trade back up towards either the 61% retracement or through to that 100% extension. Now you can see really importantly with this is that trend identification. Now in the drawings, it's nice and simple. If we take this down now and we come across to Kiwi Yen, this beautiful technical downtrend, the noise becomes more cluttered and things become slightly more complex. So let's go through that initial process again, but this time we're in a downtrend. So we're going to look to reverse what we have just discussed. So we're going to take the first high. We'll put that in red, we're in technical downtrend, and we'll come down to our current low. Okay, once that low is produced, I can put in that support level, the low of that move. We must see a break and a close below that low to confirm I have a new lower low. So that new lower low comes into effect here. Once that's in place, I can reconfirm that this is in fact my lower high. Now that first swing, we place that retracement, in this instance now in a downtrend, so we're going to come from that previous high down to the current low. The retracement was back to that 61%, fails once, fails twice. Now this is on the first swing, and we are as of yet not in a confirmed downtrend, so therefore that retracement carries an element of risk and maybe one to avoid. From here then, we repeat that process, we wait for a close below the low, and here we see that close below. So we can now confirm our new lower low. As we've now confirmed the lower low, I can confirm my lower high. And again, I'm now taking the highest point between those two lows. And if we look to introduce Fibonacci on these swings now, from this previous lower high here down to the current low, we can see this market retraced back up to that 50% region before then the market tried to sell off. We move this lower then to our current low, current lower high, and the current low. We see this market retrace back up, testing that 61% perfectly again before selling off. So let's now repeat this process. We wait for a close below the low, which happens. Notice how this price fails at the lows before then we get the break. That provides us with our new low and therefore our new lower high. So technical downtrend still in play. So Fibonacci available for this last swing from the lower high down to that current low. And we can see this market pull back to 61% once, 61% twice before now going down to create a new low. And it is a new low because we have closed below the previous lows here. You can see that close there. So technically here now we have our new lower low and our new lower highs. So we can see the process here, understand the trend, recognize your lower highs and lower lows. So important to get those correct and remove the noise and the clutter from this chart. Once you've done that, you can look to use your Fibonacci retracements. Extensions in this example also applicable. Let's take the most recent swing as an example. If we take the extension tool and I come from the previous lower high down to the current low, back up to that retracement high, we can see the 61% and the 100% levels projected out for us. 61% in this trade has now been achieved, 100% as of yet not achieved. So potential further downside pressure here for Kiwi yen in this technical downtrend. Okay, so there we are, a quick short look into Fibonacci retracement and extension, how we can use it to provide us with an entry level and also use it to then provide us with a target zone. Now, as we come through the rest of the day, all eyes will flick towards non-farm payrolls. The US in action today, first Friday of each month at 1:30. We are looking at the total number of new jobs created for the previous month, in this instance, November. And we'll be looking to see if there is going to be a beat on expectation. Now, the numbers skewed at the moment. Okay, previously a figure pre-COVID times, a figure above 200,000 would be seen as particularly positive and bullish for the dollar. Figure below 200,000 or below 100,000 in particular seemed particularly bearish for the US dollar. Of course, since COVID, we can see those dramatic spikes when COVID first hit, a huge job loss figure here. Since then, there has been a fantastic recovery. However, we're still offsetting some of the major losses we saw when COVID first hit. And we can see these numbers slowly but surely starting to pull back, starting to correct back down to the more typical levels we'd seen in a pre-COVID world. Now, the consensus for today is to come out at 469,000, so well above that 200,000 benchmark. However, that benchmark now needs to be reevaluated, readdressed, as in this COVID world, it's no longer particularly valid, but we can see that reduction. Now, the question is that reduction from the previous month of 638 seen as a negative, or actually is this now a positive sign on the fact that things are starting to return slightly to normal and perhaps economies are starting to see light at the end of the tunnel in a post-COVID world? Only time will tell. This is still a particularly high figure for new jobs claims, but we must wait to see how the market is going to react. In previous months, figures, whilst they have been high, the market reaction and the volatility around that announcement has been very low. So we would expect very similar today as these markets start to kind of readjust, realign and center themselves to what is the new normal for non-farm payrolls. All eyes to that for 130. Euro dollar traders, be mindful of that. Dollar pairs, dollar, of course, huge weakness, ongoing weakness at the moment. The dollar index continuing lower and euro dollar having an exceptionally bullish run. Look out for that pause and consolidation today before perhaps we see some volatility come in at 130 for that non-farm payrolls data. That's it for us this week. Please do join us again same time next week for another weekly market insights.